What is being done about the housing crisis?
You know, rates are low, prices are low, and that doesn't seem to be working. We don't know what to do next.
Well, this is your friendly broker, Ron Cika.
And your mortgage guru, Howard Vernick. And we're going to tell you what's being said on Capitol Hill in this edition of Contract Talk.
Everywhere we go, we hear about the foreclosure problem plaguing not only our community, but our country as a whole.
So we found the following video, which shows what Capitol Hill is proposing for solutions for this problem. Why don't we go ahead and take a look?
This meeting today, called by the private sector, is the type of meeting that ought to be going on Pennsylvania Avenue and in the capital of the United States of America. There is no single greater problem than the uncertainty in housing, and there's no single better solution for housing in the future than give us a certainty of what's going to be there so the markets know what to do, capital flows in the United States housing market over time, and it's going to take a while. It's probably going to take 5 to 7 years, but the recovery's got to begin somewhere. It begins with stability and regulation, dealing with our problems, moving forward and giving American people over time the confidence they need to go back to home ownership and back to investing in what's always been a great goal, the American dream, the single-family house.
Our message is do no harm. The market will self-correct if we stop doing harm. Conversations about increasing down payments, about the conversation about mortgage interest deduction. You can list all of them. The loan limits continue to eat away at the average consumer's ability to purchase house and confidence in housing.
You know, when the loan limits changed, to me that seemed like a very simple extension to provide at relatively limited cost.
One of the greatest inhibitors to a housing recovery, in our view, is the government's incessant desire to be in the middle of the foreclosure process.
I think a 20% down requirement for a qualified residential mortgage is overly restrictive, and it's too small. It's too tight. The sponsors weren't trying to make as tight a box as they could. They in fact were trying to make a broader box.
From 1913, I think one can say that America has become the world's superpower over that time, and mortgage interest deduction has been in place throughout. So I'm not sure how one can make the argument that somehow mortgage interest deduction has hindered economic growth.
I'd like to see leadership. I would like to take FDR's approach and make some mistakes.
Basically, you just allow people to refinance without a new appraisal. We've already got an appraisal. We know that we're underwater. The government guarantees those mortgages, and basically reestablishing a new floor, refinancing at current interest rates.
Where if you have an underwater borrower who is performing, they're timely in their payments, but they are underwater, if it's a GSE-sponsored loan, let them refinance at current rates without a loan limit payment adjustment or fees from that closing.
We need to end the dual track in which foreclosures are pursued simultaneously with modifications, another source of enormous angst, enormous stress, enormous confusion in the process.
Government-backed loans for some period of time should be assumable. We're all taking for granted these rates that we enjoy today are going to be around for a while. Well, we know they're not. Some 5-10 years from now, these are going to be incredibly attractive assets to someone, namely those people who are then facing 7, 8, 9% or whatever the rates may be then.
We need a national servicing standard for this country. Having each regulator, 50 states, all engage in their various one-off approaches on servicing standards going to do nothing more but add cost to consumers, create more uncertainty in the process.
With the echo boomers or whatever carrying such large student loan debt, we should think about maybe taking some of the money that was set aside for affordable loan modifications and look at maybe are there ways we can help people either buy down that debt or maybe pay less on, if they're not paying that $600 a month on their student loan debt, they can use it to help pay their mortgage.
It's been disappointing to us that we haven't been able to engage in real problem solving. We still continue to be focused on blaming rather than problem solving. We as an organization are holding the hands of these homeowners that need help. These people want to buy houses. We are wiping away tears. This is real human cost, And really what we are fighting for, in our opinion, is not just for home ownership and housing, but really for the future of this country. We need to set the example and lead.
Okay, so you can see from this video that there are a number of proposals out there and a number of differentiating opinions about how to fix this problem.
You know, Howard, we can all do our part by efficiently processing our transactions, including those short sales where we have some control, and of course our regular business.
So please go ahead and give us and our community some of your ideas about how to fix this problem. You know, I know we all want to get back to a normal market. So go ahead, add your comments down below.
You know, please let us know what you think. And remember, we've got your back. Take advantage of our short sale department with Linda Souls. Go ahead and use and abuse our mortgage guru, Howard Vernick. You can't imagine how much time and effort he can save you, and our title expert, Katine Abramson, can save your sellers a bunch of heartache.
Now, you know, we always appreciate the time that you take with us, and we really appreciate those comments and value your opinions.
And this is your friendly broker, Ron Cika.
And your mortgage guru, Howard Vernick, thanking you for joining us in this edition of Contract Talk.